Welcome to The Derivative by RCM Alternatives. Send it. Hello there. Welcome back. You've found The Derivative by RCM Alternatives, where I'm not going to tell you this time that there's a new website with a lot of cool stuff on it. Won't say a thing. Not even going to say the URL. You'll have to Google it. Anyway, onto this pod where I sit down with Jiro Fujisawa of Asset Management One, talking his new cross-asset factor alpha strategy. It's a mouthful, and we dig in. It's one of the most unique approaches I've heard sitting in this seat for sure. He's got 80 synthetic markets built out of real markets, going long and short, run across 3 models in trend, carry, and skew. What? How do you do that? We're digging in. Send it. All right, everyone. We're here with Jiro Fujisawa. Did I get that close to right? Hero?
You did.
Yeah.
You did, Jeff.
How are you?
I'm good, thanks. How are you?
Good. Good, thanks. When were we hanging out? In Austin, was it?
Yeah, that's right.
Talking
A few months
Hedge?
ago. Uh-huh.
It was a good time. And then it looks,
Yeah.
I'm in the middle of we might even lose power here. There's a huge thunderstorm rolling through Chicago.
Okay.
So I don't know if we can hear that rain coming down, but we haven't had rain in a while, so it's good. Looks nice and
I can
sunny
see
where
the
you
darkness.
are.
Yeah. Today's nice. Apparently it's going to start raining later this evening, and the whole week looks
There
a
you
little
go.
wet, but so far so good. Holding up.
And you live and work in New York, or you live elsewhere?
I do. So right now I'm in the office, which is on Park Avenue, around 47th Street. I live about 10 minutes of a walk, so
Perfect.
can't complain about that. Live,
Yeah.
breathe in the city. I sometimes wish I can live outside in the burbs, but I don't think I can handle all the management of a house. I think I've got enough of management on my portfolios.
Here, yeah. And who would want to do that? You talk to some of these guys who do like hour and a half commute and whatnot. You're like,
Oh yeah,
brutal.
I think a good number of my colleagues in the office, they live, especially when they have family, like kids, they live out, but very few in the city.
Love it. And then are you one of these that tries to get out of the city, go to the Hamptons or whatnot for the when
Every
it gets
now and
hot
then.
and steamy in the middle of the summer?
Yeah, or just go abroad. Like I was in Japan just till last week. I'm Japanese, got my parents, my family in Japan. So unfortunately, there's no way around getting away from the heat. It's pretty humid and really hot over there. So, but it's nice to get out of the city and get refreshed, come back, and but yeah, it's nice to be back as well.
Here, yeah. Were you born and raised in Japan, or you came here?
This is going to be a long story on its own, but
No
I
worries.
was born in Japan, but after 6 months, I started moving around because of my dad's job. He just worked for a Japanese securities firm and happened to move a lot. So first place was in Jakarta, Indonesia for 4
wow.
years, and then Budapest, Hungary for 4 years, and then London, which was the longest. I spent the better half of my childhood in London, but when I was in my sophomore year of high school, my parents moved back to Japan. So that was the first real time that I spent time in Japan. Yeah. So spent 2 years and then went back to London for university. And then thereafter, I started working in Japan. I joined Mizuho Bank, or Mizuho Corporate Bank back then, in 2013. And then I've been just going back and forth between Tokyo and New York across different functions. And here I am in New York since 2021, March.
Nice. So when you went back to Japan, you were trapped between two cultures? You were kind of considered an outsider, but you were like, hold on, I'm from here.
Yeah. So I'm always an alien wherever I go. I'm like,
yeah,
in a sense, homeless. But I also, I sometimes consider myself homeful, like I'm home wherever I am, as long as, there's some basic infrastructure and, I can speak the common language. I'm not really picky. I'm a pretty simple guy in that respect. So, once I go back to Japan, it's like, hey, you're that kind of outsider-ish, Japanese-ish person. But I sometimes or some people get surprised by how much Japanese I speak, despite me not really living there.
Yeah.
And the opposite or the same sort of happens here where I'm kind of, speaking English, but I'm Japanese kind of. I guess a lot of people in New York are like that. So in that sense, this place also feels kind of like home.
Yeah. And that was all where you were just there, Mizuho's Tokyo, or it's all over, I'm sure, in Japan. But when you go back, you're in Tokyo?
Yeah, in Tokyo. That's where the office is, my family. But I did this time around travel a little. Went to Osaka where they have the Universal Studio. My kids wanted
Oh,
to see
yeah.
the Super Nintendo world, which was really good. I say my kids, but me included.
Yeah. I
Yeah.
actually went to the new one in Orlando. What was
Oh
that?
yeah. How was
3, 4
that?
months ago. And that was super cool. I remember I was a
Yeah.
huge fan as a kid. I don't know if you're a New York Times crossword guy, but yes, the Sunday crossword was a Mario had like the tubes and the little question mark where you could jump up. It was a
Yeah.
cool little theme. But that was cool. You feel like you're in the world for a
Yeah.
quick
It
second.
was surreal. Like it was really well built. So yeah,
I didn't know
I'd
they got built one
go
in
again.
Osaka.
Yeah, they did. And I think it's like their fifth year. They had a 5th year anniversary
Oh wow.
when we went there.
Nice. All right.
Yeah.
And then where you went to school in London? Or where'd you
In
go to
London, yeah.
school? And
I
university?
went to a university called Imperial College. So I got my master's of engineering degree there. I was a mechanical engineer. I liked the maths and sciences, especially physics as a, you know, high school student or even middle school. So I thought, I wanted to study more, but not be a scientist, but be a
Mhm.
little bit more pragmatic. So the application of science, which is engineering, and so that's where I ended up being. But then, when I started off, or after I graduated, my my dad and also my brother being in the finance industry, I did my internship at a bank, and so I was interested in the application of sort of the numerical world in or statistical slash numerical world in finance. And so I wanted to join a firm that offered some sort of quant investment capacity. And I found my job at Mizuho in Boston, actually. They have a huge careers fair once a year in Boston where they hire Japanese English bilinguals. And that's where I got my job.
I want to see your like globe with all the pins on it. A lot of pins.
Yeah, it'll
A
be
lot
a
of
messy
cities.
sort of a ball of yarns going back and forth. Yeah.
And it always amazes me. I should one day go back of all the podcast guests, like way over 50%, I think, have some sort of engineering background, especially with the
Right.
quant people. So it's always amazing to me, like and it sounds like you didn't actually know you were going to be a mechanical engineer and then decided to be quant, which seems like, what's your theory on that? The people just see the world as a model that can be constructed and deconstructed and put back together. And finance, why
Um,
not? It's just another one of those pieces of the world.
I mean, I can probably spin a story all in hindsight, but
Yeah.
point in time speaking, I joined mechanical engineering or joined the program thinking I want to be a pilot. I want to build or even
Oh,
build a plane or something. But as you do thermodynamics and also do some plastics sort of materials sort of studies as well, and you have some stats, you get all these elements that are completely sort of different in its own world. They all come together to be mechanical engineering, but there's many features within it. And so I think I wasn't really thinking, oh, I want to be in finance at the point that I started college. If I had, I'd probably go into some, or I may have gone into a different field,
yeah, some
maybe
quant something or other.
exactly. But as I sort of you know, went through college and then the internship that I mentioned earlier, I thought, okay, maybe this is a little bit more exciting than, building a wind turbine or doing something else.
Yeah.
Especially back then, a lot of my classmates, they went to Derby or somewhere a bit more rural that's where all the factories are. And,
Mm.
even if some of my mates or friends also they went into the F1 industry. They're an engineer
Ooh.
there.
Well, that
But
sounds cool though.
Silverstone's
Yeah.
that does now only now I start to I watch Formula One, so it's kind of nice to see some, or I don't see them on TV, obviously, but or maybe one day I might, but it's nice to sort of see that connection I that I have.
Yeah. And then did you come to a point, or do you feel like finance in the quant world is a closed system that you can solve? Or did you come to the point where you're like, it's unsolvable and we just want to get as close an approximation and work on the percentages and things like that? That seems to
I
be where
think,
some of the engineer quant connection breaks of, is
yeah,
it solvable or not?
I think it's not solvable for very many reasons, but I think in the world of sort of tangible, real physical engineering, you can run experiments in a real controlled environment. Whereas in finance, you can sort of, or in quant finance, you can sort of simulate and backtest, but that's not the real world that we want to apply into. The real world that we want to apply into is in the future. But you know, in engineering or in science, you can sort of replicate what you expect to happen in the future in a closed environment. So I think that's a huge difference. And also, I guess data availability is quite different,
Hmm.
or some sort of homogeneous set of, or well-behaving data set is something that we lack in finance, whereas we do in many cases in the sort of physical world.
And that's like any physics classroom around the world. If you put the right ingredients and the right amounts in this experiment, it's going to come out the same. And any
Yeah,
point in time, the same students doing something in the markets is going to get a completely different.
yeah. And I think that way. I'm obviously probably really underestimating the sort of complexity, and I'm sure people working in the engineering sort of sector would probably also argue that not everything is simulatable or replicable in real life. But as I see it from where I stand right now, I think it's a little bit more. There's much more unknowns in finance.
Yeah. We used to work with a guy who did estimated the nuclear contamination in the groundwater of Pigeon Forge, Tennessee, or somewhere like that, where they had tested and built nuclear warheads. So that's right. You can't actually measure it. It's underground. So it was sampling and little pieces. And so he would probably argue to that latter point. Yeah. Like
Yeah.
even in the physical world, you have to use a lot of estimation and processes. While I mentioned, I was just arguing this with your kids. I don't know if they've done it, but like you have the classroom, hey, we're going to do a stock picking contest or whatnot. They drive me crazy. I'm like, this isn't teaching them anything. It's just like random luck. Who picks? Like, first of all, if you want to win it, you should just pick the highest beta stock probably and hope that it goes up, right? So anyway, I went off tangent there. But if you have any thoughts on how to win the school class stock picking contest, let us have it.
Yeah,
Design a model.
that's a difficult one. If I knew, I would probably do it on my PA.
Exactly, because it's like,
Yeah.
what's going to happen over the next, and it's such a finite time. It's teaching them bad lessons. So you mentioned Mizuho. You technically work for Asset Management One, correct?
Yes.
So tie that whole picture together for us, how that all came to be and what's happening there.
Sure. So it's a little bit of a complicated or a different animal, or the whole chart system in a Japanese large institution is quite different from the standard practice over here. But there's a lot of transfers in Japan. So even if you join a firm, you tend to get rotated, or at least that was the sort of traditional way of incubating or building in-house capabilities in a Japanese firm. So,
But by your own choosing, or they would just take you and say, now you're in this department?
kind of both.
Yeah.
It's a mixed sort of system. But when I joined, I specifically joined under the terms that stay within the sort of asset management division, and I had my specific goals and things that I wanted to do, and I think that I'm good at, which is kind of in the space that I'm at. So when I actually joined Mizuho Bank, I was first sent to a sort of funds of funds / gatekeeping division. So I was looking at global macro players like the Brevin Howards of the world, and
Yeah.
Millennium, and usually the blue chip names of hedge funds. And I was advising Japanese institutional investors, mainly in the pension space, as to how much or what they should invest in and how much, et cetera, et cetera.
Were you any imposter syndrome of like, why am I in between these $1 billion transactions? As a gatekeeper, I'm just getting used to this stuff.
Since that was kind of like first role, I didn't really, have really hard expectations as to what is the kind of the standard.
Yeah.
So it was a good experience.
Love it. And then just to back up, what's the company line?
The financial group has various arms from banking. It covers retail and also wholesale. It also has securities, kind of the investment bank division. It also has a trust bank, and before they used to have many small subsidiaries that have been doing asset management, i.e., running external capital and doing money management. Now, because we had multiple firms, we merged all that into one big entity in 2017, and that's where Asset Management One. That was when it was born. So Asset Management One, where I work, for whom I work, is a company owned by Mizuho Bank and Daiichi Life. So we've got two parents, Mizuho and Daiichi Life.
When you were allowed to do that as a bank.
Yeah, exactly. And then at that point, we sort of decided that we want to run external capital. And then 2010-ish, Risk Premia 1.0 came about, and then 2.0 later on, and QIS recently. Whatever, there's a lot of
What are we
names
calling
to
it
what we
these
do.
days? Yeah,
I don't know, just Quant. Let's keep it simple.
Risk Premium. And then so you're actually in there, or over your career, been in there coding, creating various risk premium models, various QIS.
So I started this particular role 2017. I initially started as a trainee here. I did program back in uni days. I did MATLAB and R, but not in Python. So I had to sort of, not relearn, but sort of transfer my sort of language from those languages to Python. Develop my own strategy, get grilled at the investment committee, and come up with some prototype. You let it run on no capital. So we typically, once we have a strategy developed, we tend to have a sort of dry run period of a few months, and then we would put some capital allocation and then gradually increase as if it makes sense.
And then these are all supposed to be or designed to be betas, for lack of a better word, right? They're just known risk premia, or maybe they're a little bit only known to you risk premia, or something
I think
of
it's
that
a
nature.
mixed bag of both. I think arguably it's very rare to find any sort of groundbreaking, revolutionary idea that prints money and is different from everyone else. I think there's various reasons as to why that is the case, but firstly, by definition of a quant, it has to be statistically significant. So whatever phenomena that you're trying to capture, you need it to be. It needs to be significant. You can't just try to capture a really short term thing in size and scale. So I think a lot of the times we do source our ideas, or at least more on the sort of traditional factors from academia world. So it's much more discovered. Usually that comes with some intuition, which is something we always like to have.
Right.
But
There's
I
a
think
paper of buy on Tuesday morning, sell on Wednesday evening. And that just was the whole concept. You'd be like, well, why? Yeah. So you're against that. You want to know why.
Yeah. Sometimes it's a little easier to explain than some other times. It may be a little bit more heavy on the empirical evidence as opposed to more fundamental. Oh, there's these kind of flows are driven by these kind of retail flows or whatever. It's not always fully explainable, but it at least needs to be intuitive. We can't just be looking at data and trying to data mine it and come up with a beautiful
Right.
back test of a
And
sharp of
then
3 or whatever.
give us like 5 examples. Carry,
Carry,
FX
value,
carry. Yeah.
trend, maybe not really
Sh-
risk premium, but like what we do
short
have
vol.
some defensive strategies.
Hmm.
Shortfall, I guess that's kind of an extension of carry, but different
Yeah, yeah.
from like a curve carry. But yeah, those would be the typical sort of traditional factors. But
But then
we
that's
do
oh,
also,
sorry, go ahead.
sorry, I was going to say we also do have a little bit more of a niche, or if you like, a bucket, which we call market imbalance,
Mm.
which is a sort of omnibus category for various things that the premium that we try to harvest by providing liquidity to the markets and getting that premium out of it. It can be like a really well discovered covered one is, congestion. There's certain flow patterns or dynamics in markets that we try to provide liquidity and gain money out of it.
And is that as the bank can provide that liquidity, or any investor could access that premium and provide that liquidity?
I think any investor can access it. It's just whomever can provide that liquidity, at least theoretically, gets that premium. So
Yeah.
it is risk premium in that sense. If that flow or if that thesis doesn't hold, then you that is the risk that you hold.
And then talk for a minute. There's been some papers. I mention this all the time. I should go actually get the actual name of the paper, but right, that once a risk premium is published, its efficacy declines quite a bit, right? And once it's like out there in the
Mhm.
public and all the investors are using it, have you guys seen that in practice? Do you have a number on it? Like, what is it still good enough, even though we know it's not going to be like what was in the paper? Like, how do you think
Yeah,
about all that?
I think it differs from factor to factor. Some factors that rely on, especially on certain flows where, maybe if everyone piles in on that flow, then you might have certain market concentrations that sort of essentially killed that premium that used to be available. But in other cases where, maybe in certain commodities markets where, that the impact of that isn't as large as the underlying sort of flow mechanism, then the impact is marginal and shouldn't impact the efficacy of that factor. And I think it's difficult to say that, okay, because a lot of players are piling on the same bet, risk premia has a sort of life expectancy of X number of years. I think the really fundamental risk premia strategies should work in the long run, but I think it's also about parameterization. You don't want to be sort of always tweaking it, but I think the design of a strategy should be able to take into account of these adaptations in the market. So I think that's what we really value in our research process. So sort of tying that into what we talked about earlier, there's very little groundbreaking ideas, but I think the importance or a lot of value comes into the detail of the construction. We just call them implementation in our shop, but I think that's the key in delivering a good strategy within the risk premium space.
And something as simple as like execution algos or speed of execution, things like that can
Yeah,
be part of the game.
agreed. Agreed.
Uh, and then, so it's always funny to me. We talk about, well, there's 5, 10 risk premium, but then how many are actually on the platform? Like hundreds? And is that just tweaks or different parameter sets of known factors?
If I had to put like a number on it, I'd say maybe 40, 50 purely different ideas, and then there'll be hundreds of different variations for different purposes. I think that's the sort of
Yeah.
ballpark
Right. If I
range of
run
things.
like a PCA analysis on that, I'm going to come up with like 50 unique bets, maybe.
Maybe. So I think the sort of ex ante and ex post worlds are
Mm,
two separate things. Conceptually, one risk premium strategy may be completely different from another, but at the end of the day, they kind of look similar. If
yeah.
you, I don't know, run a correlation on those strategies versus the SocGen CTA index, you might get like 0.6, 0.7 sort of correlation. So in that sort of long run, maybe the correlation structure may be quite similar, but that's kind of looking at the longer term trend or the longer term behavior and the similarities. But I think when you're looking at your P&L day to day and the positions in certain markets, the slight difference could make a huge difference in the sort of end return of if you compare different strategies over the same period.
And then do you feel like investors, t- to me, it's like what happened to cable, right? Cable, we had all the channels bundled together. I'm getting one nice product. And then everyone's like, no, I don't want the Hallmark channel. I don't want this. And unbundled. Now I can get all these different pieces. So it's basically what QIS or risk premium is, right?
Hmm.
The investors can get
Yeah.
just the pieces they want. They don't need the Hallmark channel. Or I'll flip that. The people who love the Hallmark channel, you don't have to have ESPN. But I'm assuming most of our listeners want ESPN and don't want the Hallmark channel, which might be put a note in the comments. Let me know if you want that Hallmark channel. But anyway, in the cable space, now we've seen it kind of rebundling. Like people got too
Right.
much choice and they didn't want to have to manage all these different streams. And now they're like, can't you just put this back together to me? So any risk of, or maybe opportunity there, of like, are people trying to manage this or how do they manage all those choices? Are they starting to say like, can you just bundle these ones I want for me?
Yeah. I think the key is in having the flexibility to provide both. So they can choose to choose or not to choose. Typically, when we have conversations with certain investors, we would sort of start off by, having a sort of default basket of strategies, one sort of portfolio, if you like. And then certain investors, we would sort of go into the details of what goes into that portfolio, and then maybe some investors may already have trends that they don't want any
Right.
more trends. So if I weed that out, then okay, that directional component within the portfolio is gone. So how do I sort of make that basket a little bit more well-rounded between the different kinds of strategies? So I think if certain investors may want to just end the conversation there, but others who want to have that sort of piecewise offering, we can, sort of have a conversation that goes more into detail of the specific factors or strategies that go into it.
And then do you see investors more, are they doing risk premium instead of a multi-strat hedge fund or whatnot, or in concert with? Of like, okay, right, the multi-strats are hiring a bunch of different PMs. They're doing a bunch of different risk premia. There's a center book. They're weighing it all, or a pod shop if you want to call it a pod shop. But they're basically
Right.
using all those risk premia and balancing it internally, giving you one return.
Hmm.
What are these investors after? That same thing? They want to build their own multi-strat essentially?
I see both. I think some some people might just want the sort of, some of the strategies have already some stat arb or some
Yeah,
sort of
yeah.
quant element into it. And then they actually want some additional exposure that's complementary to what they already have, which is where sort of the QIS / risk premium stuff comes in. We're not a hedge fund that sort of is set up in such a way that we have multiple PMs separated by separate different capital allocations and sort of competing PM by PM to get the best single portfolio. Where the approach we take is a little more collegial and more sort of institutional approach where we manage one book, different ideas, different factors or strategies that go into one single portfolio, but it's more homogeneous, if you like.
Yeah.
We
More
use the same
customized.
building block. Exactly.
Yeah.
Same building block, but different mix and match for different clients.
And then my last question, maybe, but I'll say it's my last question on the risk premium. say I wanted to build these all myself using Claude Code or whatnot. Where does that lead me? You think it is achievable, or I end up with just an implementation problem, right? Like I feel like that's the people are going to start to say, well, I don't even need these banks now. I can just build this risk premium myself.
Right. It does a good job in trying to get the overall gist of things, but I think kind of repeating what I mentioned earlier, the devil's in the detail.
Yeah.
Those details Claude may not, or any sort of AI bot may not be able to capture, and that's where exactly things blow up in your face when things don't go right. So it becomes an issue of accountability. Do you want to risk your capital in doing it and taking that approach? That's probably where the cost of relying on a AI agent
Yeah.
is.
What's a bet on is the public knowledge of everything that could go wrong public, or the secrets of what can go wrong internal to a group like you, right? That hasn't been published out there, but has been fixed and corrected, and right, you know where the pitfalls are,
Yeah,
and maybe didn't publicize all that.
right.
Interesting to think about. All right, we're going to rename the pod Bury the Lead because you started a new strategy and now we're just getting to it 30 minutes later. Inside Asset Management 1, cross-factor asset strategy. The new strategy, give us the 30,000 foot view of what you're doing with that, and then we'll dig in some more.
Sure. So it's actually called cross asset factor alpha. You missed the A at the end.
Yes,
We call it CAFA
CAFA.
acronym. So sort of rewinding, setting the background. Asset Management One, we've been running a suite of products that that invest in risk factors. What I mean by that is instead of investing in ES or TY or GC or specific markets, we sort of try to decompose the investment universe into the different components of risks, and those are called risk factors. So each risk factor is a basket of assets. It's a long short combination, and it changes over time. Not every day. We try to stabilize it, but it's essentially a basket of assets. So we try to trade those baskets, and we've been doing this for a long time. But there were certain constraints in some of the existing products where these funds had to be long biased, so that we're not overly short at any point in time, just by the sort of nature of the client demand at that point in time.
Yeah.
Now, while we have been doing that on the other side of the pond in New York, we've been sort of doing the quant CTA type strategies where we're long and short, we try to be market neutral, and so we sort of combine the two worlds of this risk factor investment and the sort of long short CTA type approach, and came up with the new concept, which is what CAFA is. So we look at an investment universe of about 80 different futures market. We try to decompose that investment universe into a finite set of risk factors, and then we invest in these risk factors in a long short manner. How do we do that? We look at various risk premia, ranging from trend, looking at skewness, and also carry. So what we try to achieve in doing this is, firstly, we get orthogonal bets by the fact that we're investing in these synthetic assets, which are by construction orthogonal to each other. When we do the risk factor extraction, we design it in such a way that we're extracting orthogonal factors. And then the second layer of diversification benefit that we get is that we're taking multi-factor approach. We're not just doing a trend play or just doing a carry play. We're taking multiple approaches.
All right, a lot to unpack.
Yeah.
I'll start with the risk factors. Do you have examples of some of the risk factors? Is like liquidity or right? Give me a couple examples of different risk factors.
We try not to put names to it. We try to stay a little bit more statistical at that point. We don't want to sort of inject our own view as to what is driving markets, especially when it comes to a sort of wide range of assets that, the 80 different markets we look into ranges from equities to bond futures to FX and commodities. And especially commodities, there's a whole wide range of things. So we want to remove any sort of bias. So typically, PC1 would be like sort of the growth sort of factor if you look at general investment.
And how many are there again? Risk factors?
So we would go up to about 80, same as the breadth of the markets. Obviously,
you got to change that because that really confused me in Austin, and we'll see.
I see.
Right? It'd be better if we had 100 risk factors and 60 markets. Then we could keep those. But it's 80 risk factors, 80 markets.
Yeah, which I think is a little bit more one-to-one, right? It's
yeah. All right.
Yeah.
And so that risk factor, call it growth, and I'm just for simplicity's sake going to call one liquidity. But you're saying it's just a statistical, like we were talking about before. I'm going to run my analysis, and there's 80 distinct factors here, and that's before putting them into the synthetic market. So that's after the synthetic market.
So these are the synthetic assets. So let's say the first factor, risk factor, is growth. Growth is, maybe it's long equities and short bonds, and it'll have 80 different positions across the different markets. That is the synthetic asset number one. So each risk factor is a synthetic asset.
That's why it's 80 to 80. It's one. They're the same thing, just kind
Correct.
of viewed separately.
Correct.
Viewed at a different angle. Okay. So then you have all 80 are in each bucket, all 80 markets?
Yep.
That's crazy. And so, got it. So in bucket one for growth, maybe I'm long stocks, short bonds, short gold, yada, 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 long crude oil, something like that. Then factor 71, I might be a different mix of those, or I will be a different mix of those, right? Short equities.
That's right.
So at the end of the day, is this all 80 are working together? Is it weighted amongst the 80, or are they just all offset in some way, and whatever you're left with, the net is the position of the portfolio?
So when I look at the portfolio, there's three different buckets, three different major buckets, trend, carry, and skewness. So if I just start with the trend bucket looks at the 80 synthetic assets and says, which one should I buy and which one should I sell and how much? So trend may say, okay, synthetic asset number one looks trendy in the positive way, so I'll buy that. And then, synthetic asset number 3 is trending down, so I'm going to short that. And do the same for all 80 synthetic assets. And then you have that trend bucket. The trend bucket, technically has a little bit of a different sort of trend measure within it, but we'll sort of leave that aside for
simplicity. And so that different question. So each of the synthetic markets, you're building a record of its price movement.
Correct.
Yeah. So then all three of those models, trend, carry, skew, are going on top of the synthetic price action. And then I can see, okay, this synthetic 1 is trending up, synthetic 3 is trending down.
That's right.
And so sticking with the trend, well, can it be 80 long trend, 0 short, or just in practice? No, it's always going to be somewhere around 50-50.
So we do apply a constraint at the end to make sure that we're not overly betting on any synthetic asset, or also right at the end, we also apply a market level constraint where, we sort of transpose from the risk factor or synthetic asset space back into the real world specific contract base. We also don't want to pile on to any sort of single market. So there's multiple levels of caps that we apply, but even at the sort of synthetic asset level, we try not to take on too much directionality, but specifically for trend, because it's a directional strategy by nature, we could be long bias or short bias at any point in time.
Yeah. And depending on each of those models. And then
That's right.
is it hard to explain, right? It's like how to
It
say
is.
not even how it works, but I understand how it works. But now moving forward of like, okay, what am I rooting for? Like it's hard. A trend is hard enough to explain what you're rooting for to people. But now you're like,
Right.
well, it's the synthetic is long, short, these different things, and we're rooting on that.
Yeah.
But
I think that's what sort of it's difficult to explain, but because it's difficult to explain, it sort of captures a whole new dimension
yeah,
of price actions. And we're not trying to overcomplicate things to confuse people, obviously, or to sort of just for the sake of making something new, because statistically, or at least each process that we apply goes back to our philosophy. It has to be intuitive. So as a whole, it may be complicated or a little bit difficult to explain, but every decision that we make ultimately leads to us, or we believe that it allows us to achieve much better orthogonality and stability in the long run.
right. And that's for my friend George. Orthogonal is just basically non-correlated, right?
Exactly. Yep.
Yeah, a bunch of unique bets. But so it's really diversification on steroids, right? Because each of these,
Hmm.
right, you've completely eliminated single markets. So now these synthetic markets, each of that is a more diversified version of the underlying what's inside of it, right? So each of those buckets have less volatility than for sure, right? Than the sum of the markets inside of it.
The volatility of each component, it's uniform. I obviously
Hmm.
within the portfolio, you can allocate more vol or more risk than
Yeah.
others. But each unit, when we look at these, each
So you all
uh,
weight them to be equal.
or when we look at each individual synthetic acid, we sort of compare it on a sort of equal vol level. But
Yeah,
when
yeah.
how much we include it, really, it's driven by the appealingness from each trend, carry, or skew lens.
And then those trend carry skew are equal, third
Correct.
exposure
Those
to
are
each.
equal. Yeah.
And then each of the 80 synthetics is equal. See, right?
So that
Or
would vary.
risk weighted equally. Or if you're like model 17 has
Yeah.
been killing it for the last year, we're going to overweight model 17 or synthetic 17.
So if I take the trend model, it would look at synthetic acid 1 to say 80. The trend model will allocate more to acid number 1, synthetic acid number 1 versus synthetic acid number 2. So it won't always have the same vol or same
Because it's
allocation.
more
It's
trendy or
agnostic.
whatnot. Yeah.
Exactly.
Okay.
And we don't have any
So
sort
it's
of
like,
prior view.
and then, so we mentioned these. So the 80 synthetics change over
Yes.
time.
Over time it
And
does, yeah.
how often is that?
So we observe every day and we adapt, we trade on it every day, but it doesn't mean that we're flipping around the positions every single day. It's gradual. We look at a long enough period, not too long, but not too short, sort of time horizon to be adaptive, but also not be too sticky.
Yeah.
So, if there's a change in the market structure, we will be able to capture that, but we would incrementally change that day by day.
And something like, I'm thinking back to like Swiss franc depegged or something. If you had that in the portfolio, that would be something that would, like, now that vol is 10x what it used to be. There's
Right.
time for a change.
So that's when, those kind of scenarios, I think it's very difficult for a statistical model to adapt to. And that's where I think our job as a portfolio manager step in to make that assessment. We're fully systematic. We don't want to impose any of our judgments within our portfolio. Obviously, there are at the stage of designing a portfolio or even a strategy, there's a human being is building it. So there's definitely some human input. But once we built a model, we don't override any decision unless there's some extreme market event and we have to step in from purely from a risk management standpoint. And I think that sort of, Swiss franc deep pegging, or even a little bit more recent, the ruble sort of liquidity drying up,
Yeah.
that those kind of events we would intervene, and we don't want to be stuck with the positions that we can't get out of, or can't get out with a reasonable sort of spread. So only in those times we would intervene and step in and make changes. But we don't take it lightly, and it's not a simple exercise, especially when you have a lot of models that contribute to whatever positions that you have. If you just blindly just rip out that position, you may be exposed. If you're doing some sort of relative value play on that positions versus another, you're sort of susceptible or expose yourself to certain beta risk or some
it essentially
directional risk.
changes all 80 synthetic markets, all right? If it's in all
Exactly.
80. But to me, you've built the perfect thing to not tinker or have opinions on that, because I don't even know what, right? If synthetic number 14 goes long, like I don't know which markets are actually in there, so I don't have to have the normal systematic manager thing of like, why are we going long oil here? This is just going to reverse as soon as they make a fake peace deal or whatever. So you've solved that problem. What's next? Will you go to 100 synthetic, or what's in the research pipeline?
No, I think just creating more new. I think one obvious avenue of research is, are there more factors, not risk factor, but alongside trend, skew, carry, is there anything else that's sound that we can sort of add into that mix if we were to specifically talk about CAFA? But outside of the CAFA world, there are other initiatives, other research topics. But I think for CAFA, we definitely don't want to sort of increase more synthetic assets. If you start trying if you start trying to expand on that more, you sort of incur this instability, and also you're sort of adding on a lot more noise than value. So I think we're happy with where we are in the synthetic assets.
And then which did we cover before? Like, how did you arrive on the 80 in the first place? Like, that was, you ran the component analysis and came out to 80?
So it's more to do more a sort of mathematical exercise of how much breadth can you get with n number of assets. Usually that's sort of, if you go way beyond n, so if we have 80 different markets, if you try to extract 200, or something ridiculous, then you're picking up a lot of noise and just not really extracting anything.
Law of diminishing returns, essentially.
Yeah. So I think 80 was its limit, but you also don't want to just pile on to like 2 or 3 different things.
Love it. I think I'll see you here in Chicago in October, right? You're coming to the conference?
I believe so. I'll have to check with Mark on that, but it'll be nice to do a trip there.
For sure. Any last thoughts? Want to leave us?
No, I think, we've it was a great pleasure to be on this. Thanks again, Jeff, for having me. I think Quant in general has had a tough beating over the few years. Finally, it's becoming a sort of field where people have started to revisit. And even though the stock market has been very bullish, despite what's going on, I think it's people sort of started to look at, if and when markets turn around, how do we sort of diversify our portfolio out of sort of the PEs and the Mag 7 or AI stocks.
Yeah.
So I think it's an exciting time for us.
We didn't cover that. Like, this is supposed to be an absolute return vehicle, right? Doesn't care what the market's doing, doesn't care what the economy's doing. It's going to do what it does regardless, right? Would you put it in that bucket? It's more of a absolute return versus a crisis period performer or something like that.
Mm-hmm.
Yeah. Love it. Well, it's cool. I think you've nailed it, right? It's like a systematic multi-strat, systematic quant multi-strat. We'll come up with some cool words for it. All right, Jiro, thanks so much. We'll see you soon. Okay, that's it for the pod. Thanks to Jiro for coming on. Thanks to Jeff Berger for producing. Thanks to RCM for sponsoring. Drop us a comment, drop us a note, invest@rcmam.com. Check out that new website, and we'll see you next week. I'm not sure who we'll have. Maybe Jerry Parker, Trend Royalty, maybe a newer commodity manager. One of those two. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter @RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.